Hey, Dan Passarelli here. How you doing today? We're back. We're back. Welcome, welcome. All right. Let's see here now. Before we get started, we're going to talk, well, first of all, let me introduce what we're going to talk about today. We're going to talk about why your covered call trades don't work, and more importantly, how to fix that. Now, before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investorservices@theocc.com. Now, I want to make sure you can hear me. If you can hear me, please go to the chat box and give me a big old woohoo. Please hit that chat box. Let me know that you can hear me. Chat box or the Q&A box. You can hear me? Okay, Q&A box. Woo-hoo, Chris, you're back for more. Excellent. All right. Oh, okay, thanks, Matt. You guys are awesome. Hey, Maria, what's cooking? Hey, Ray. Thanks for the note on the chat box. Matt. Hey, Chris. Yeah. NTIS again is back for more. Great. All right. So as you can tell, I pay attention to who shows up. I know you, but if you have not been to one of these Firstrade webinars before, allow me to introduce myself. My name is Dan Passarelli, and I am an author of a couple of the top trading books on options specifically. And I'm a trader. Started out my career trading on the floor of the Chicago Board Options Exchange. Traded just a little bit upstairs, as they call it, which is off the trading floor professionally, and traded on the Chicago Board of Trade as well, CME Group. And now I trade in a retail trading account, just like you. I'm the founder of Market Taker Mentoring, which is the global leader in option trader education. And I'm a trading industry collaborator of sorts. I work with many of the options brokerage firms, most of the big ones in the US, some abroad as well. Work pretty much with all the options exchanges in the world as well, literally. So I get around. And when I'm not getting around, the options industry, I'm hanging out with my family because that's what I like to do. My wife, Kathleen, my two adult children, Sam and Isabel, two cute little dogs, a Yorkie and a Morkie. And we do lots of fun stuff together. I'm a runner, foodie. We do a lot of traveling. We enjoy music. And that's who I am. Now, enough about me. Let's talk about the important person here. Let's talk about you and what I'm going to do for you today. First thing I'm going to do is I'm going to make sure you have every single thing you need to be massively successful in trading covered calls. And the one thing that you can do is type this into your browser right now, markettaker.com/cc guide. Market like stock market, taker as in take what is rightfully yours, 2 T's in a row. Markettaker.com/cc guide and grab this free strategy guide. That is going to help you get even more out of what we talk about here today. That's my gift to you. Now, are you familiar with covered calls? Hit that questions box again. Give me a yes or a no. Are you familiar with covered calls? Have you traded them before? just keep it short. Like no means not familiar. Yes means familiar. Traded some means you traded some. Okay, we got a yes. Oh, Matt's done it 2 times. Very cool. Okay, good. You got your feet wet. Traded some, says Dominic. Okay, cool. Hey, Dominic, nice to see you again. Okay, good. So we got some experienced folks here. I didn't see it years ago back during the dot-com bust. Oh, lousy. Okay. Well, quick review for the folks who haven't looked at these in a while or maybe are not familiar with them yet. A covered call is a two-part strategy. There's two legs to the strategy. One is I own shares of a stock, and the other is I am short a call. For every 100 shares I have, I am short one call against it. And short means like I don't own it, I don't own the call, but I sell the call. So what does that mean? It means, well, think about what owning a call means. If you own a call, you have the right to buy the stock at the strike price, right? You can exercise that right on or before the expiration date. So if I'm selling that right to someone, somebody has the right to buy my shares of stock from me at the strike price. And that's if they choose. It's a potential obligation to me. This is an investor-oriented strategy, and it's generally considered a very conservative investor strategy. Now, there are numerous studies that show a lot of benefits to trading covered calls. Specifically, it does two things at once that are both exactly what you want. It can outperform the buy and hold strategy, what I call the old buy and hold strategy, while at the same time lowering your risk. Now, look, when you first started learning about trading or investing, at some point, somebody once told you there's a trade-off between risk versus reward, right? If you want more reward, you have to take more risk, right? If you want less risk, you're going to get less reward, right? You've heard that. This takes that relationship and optimizes it. We actually get less risk and more reward, which is really, really powerful stuff. And there have been a number of white papers written on the subject, and I'm sure I can dig one up for you if you're so inclined. Just, if you make your way over to my website, I can hunt for one and email you a copy of it. Just contact me there. But there's been a number of white papers written on the merits of covered calls in outperforming the buy and hold while lowering risk. So, why might an investor choose to incorporate covered calls into their investing strategy? Well, because it can outperform long stock while lowering risk. It's like it optimizes that time-tested relationship. We can generate income on low volatility stocks or ETFs. We can lower the cost basis of the stock. Now, I want to be clear for a second here that that is not like for tax reasons. That that is not that is not tax advice. It brings in money so that the amount that you paid for the stock, incorporating the option premium, is a lower amount. So it can lower the cost basis in that regard. And you can potentially set an exit strategy for a stock or an ETF, which is one of my favorite reasons for doing it. So let's say I want to buy a stock, or maybe I already own a stock. And personally, I like to do these most of the time. I would say about 97.5% of the time, I am trading these on a stock that I already own. And the stock is, kind of steadily rising. You know, I like it as a long-term investment, but it's not one of these that's really like taking off to the moon or anything. So we want to lower our standard deviation, lower our risk. That's how we measure standard deviation in trading. And we want to have as low a cost basis as possible. We don't expect the stock to break out. We expect rather a steady grind higher in the stock. And that's very, very key. We don't trade covered calls on like every stock. They're advantageous for certain scenarios and not for other scenarios. This is the scenario. So here's what we do. We buy, or we already own, 100 shares of said stock at $70 a share. And what we do is we sell the November 75 call at $2. All right. So first of all, what did we do here? Well, okay, we have 100 shares. And we're selling somebody the right to buy this stock from us at 75 bucks. Now, you think about it, if I own the stock at $70 and the only way that I'm going to get assigned and have to sell my stock is if it goes up to 75, that can potentially be a beneficial strategy. Now, not universally. And I see Catherine here is asking kind of a long question, Catherine. So I tend to hold all questions till the end, especially longer ones. Otherwise, I get off track. But I see it, and I'm going to answer it. So, the one thing that I'll say in advance is covered calls are appropriate for some scenarios, but not all scenarios. Okay, so I'm selling somebody the right to buy this stock from me at 75, and they have that right till the third Friday in November, and they're paying me $2 a share for that. Now, each call represents the rights on 100 shares. So basically, I'm getting $200 cash deposited into my account. So my intent with this is I want to hold the shares even after November expiration. This is part of a long-term buy and hold strategy. People will call covered calls, when we incorporate covered calls with another strategy called cash secured puts, they'll call that the wheel. And each one option trade is sort of one spoke in the wheel, if you will. The stock is the stock, and each option trade is one little component of a long-term plan. So I'm doing this because I want to lower my standard deviation, my risk, during the life of the call, and will have a lower cost basis after the call expires. So let's take a look at this. Long 100 shares of the stock at 70, short one of the November 75 strike calls at 2. So if I hold this position, this two-part position, stock, long stock, short call, and if the stock goes up and is trading above 75 at expiration, I hit my maximum profit potential. That profit potential is $7 a share. So 700 bucks. How do I get to that number? Well, if I own the stock at 70, and if it goes up above 75, the person who bought that call from me is highly motivated to exercise it. Because if the stock is trading above 75 and that person has the right to buy it at 75, they're going to do that. So we're going to sell the stock at $75 a share. Okay. But we also, so buy at 70, sell at 75, there's $5. But that $2 that I collected when I sold the call is also still mine to keep. So that's total of $7 profit. Now, if the stock does not go above $75 a share, well, then that's fine. I still own the stock. And when those calls expire, November expiration, that $2 just remains mine to keep, and that obligation to potentially sell the stock goes away. And basically what I do is I outperform the buy and hold strategy, because one way I can think about it is that, okay, sure, I bought the stock at 70, but I've got an extra $2. So my cost basis, or my break even, is the stock purchase price minus the call premium. It's like after expiration, I mean, even before expiration, it's like I own that stock at $68 a share. Now, again, when I say cost basis, that's not for accounting purposes and it's not for tax purposes, but that's how your brain should think about this. Okay. So another way to think about this is as long as the stock is below 75, this position always outperforms the simple buy and hold strategy by the $2 premium I collected on the call. Even if the stock goes down to 50 and you're losing 18 bucks, 30% or something like that, whatever the math comes out to, I'm still doing $2 better than I otherwise would have. Only if we're above 75 do we not outperform by $2, but it actually takes us all the way to $77 a share is what we call our indifference point. Whereas if it's above 77, well, we wish we didn't sell the call. I mean, can we really wish that much? I mean, we still have a nice, healthy profit. But if we're anywhere below 77, we're always better having sold the call. All right. Risk reward recap. So to the upside, there's limited profit potential and we might get assigned. So we need to monitor and actively manage. Now, is getting assigned a bad thing? Not always. It depends on your objective. For me, it's typically not a bad thing. That's often part of my plan. Now, the downside, if the stock goes down, it's the same risk of owning the stock, but I get that extra cash, which I just, in my mind, P&L against what I paid for the stock and look at it as just simply a lower cost basis. So I kind of need to monitor and actively manage there too. Unless, of course, it's a buy and hold strategy where I'm going to buy it, plan on holding it for years and years and years. And if it goes down a little bit in the short term, I don't really care, right? And this is the difference between traders and investors. And this is an investing strategy. With traders, it's okay to get a little skittish and say, oh, I'm down a little bit. I got to cut my loss, keep it small before it gets to a big loss. With investing, like long-term buy and hold investing, if the stock is down some, it doesn't matter. I'm going to wait until, I'm going to wait. Uh, Catherine has a couple questions. I'm going to hold those for till the end. But she says, by the way, other than there were a couple that she had a little bit of trouble with. She says, by the way, other than these examples, selling covered calls works like magic, very profitable overall. So yeah, I'm looking forward to addressing those questions. Those are great ones. So managing the upside. If the stock goes through the strike price, there's good news and maybe bad news. The bad news is optional. It's kind of in your head. The good news is you made money. You made your maximum profit. And the bad news is you could have left money on the table. But I mean, have you ever put in a limit order to sell a stock that you own? Has anybody ever done that? Like a good till cancel limit order to sell a stock that you own? I've got probably 20 GTC orders, or of course on Firstrade, they're GT90 trades, good till 90 days. I've got probably 20 of them in right now. I love GTC or GT90 stuff. So this is basically like working a limit order, but you get paid to work the limit order. Whether it gets filled or not, you're going to get that $2. So you can make a case for saying, hey, if I own a stock and I want to sell it if it goes higher, I'm going to sell a call and just hope I get assigned. I actually analyzed a trade like that just today, but I wasn't able to get enough premium. If we have time, I'll tell you what stock that was and give you a little bit of detail on it. So as far as managing, look, we can wait for assignment. That's really what I do a lot of the time. Or I can buy the short call and just close it. And I can buy it if it goes against me and roll it to a higher strike, maybe. Or for me, whenever, like I just put in some covered call trades on Amazon earlier today. And as soon as I got filled on that covered call trade, you know what I did? I put in a good till cancel order. You can put in a good till 90 order, GT90, to buy it back at 4 cents. Because once you get down to like under a nickel, if you got a couple of days left, you're just going to be waiting around, you know, a day or two or three to try and make literally $1 of cash. So that's ends up being kind of silly. So I always buy them back early, around 4 to 6 cents, and then just close another one. In fact, that's what I did. I had a 4 cent, I had a covered call on an Amazon. I had a 4 cent good till cancel bid in, and I was looking at it and I saw that I could buy it at 6 cents. And I thought, why wait? What if Amazon shoots up over the next couple of days? Because they expire Friday. So I just went up, paid 6 cents, and rolled out 2 weeks. Same strike, 175 strike, if I'm not mistaken. 175 or 195, one or the other, I forget. And collected another $1.36 or something, I think it was. So $136. Done. Okay, so these are the things I can do. Now, a couple of considerations for what kind of an account should I trade this in? Should I trade this in a regular account or maybe in my IRA? Now, me personally, most of my covered call trades are in my IRA because they're investing trades, an overlay component to the buy and hold strategy. And that's what I do in my IRA, I buy and hold. So as far as capital, lots of investment capital can be appropriate for taking assignment, right? Like there's another kind of twin of the covered call. It's called the cash secured put, where I sell a put and I hope to get assigned, which means I end up buying the stock. And, if you have cash in your account and you're thinking about what stock to buy, that's a great way to get into it. Your time horizon or objective. It's not necessarily for the life of each individual trade, but for the overall strategy, if you have a longer time horizon, which you're usually going to have with covered calls, that makes it pretty suitable for an IRA. Plus your aggressiveness. Generally, IRAs, let me phrase that in an even better way. We tend to be more conservative in IRAs, and this is considered a conservative investor strategy. Okay, so I said before, this is good. Covered calls are good for certain stocks and ETFs, but not all. The conservative nature of covered calls in general means we probably want to avoid biotechs, especially like very, small biotechs, like pharmaceutical companies that have one drug in their portfolio that's about to be released. Leveraged ETFs are probably not really good for covered calls. And those things can be the kiss of death for IRAs. Now, maybe you get really aggressive in your IRA with some component or with some part of your capital, and there's nothing wrong with that. But I think generally we like to have most of our capital employed conservatively with IRAs. Also, inverse ETFs. First of all, I don't understand why inverse ETFs even exist, to tell you the truth. To me, inverse ETFs exist for people who don't know what puts are, because you can take bearish positions on an ETF by using the options. So you kind of don't need them. And it just kind of makes covered calls a little weird trading them on inverse ETFs. Now, unless you have some reason for trading one and you're trading it and you want to put in that, limit order that you get paid for using the covered call as an exit strategy, that's about the only way I could justify using them on an inverse ETF. And VIX products can be used for hedging, but generally should not be used by most investors. And I don't know if we really do a lot of covered calls on VIX products. So selecting underlyings for covered calls. Here's another way where people tend to go wrong. Generally, we want stocks above $20 a share to get big enough premiums. Now, every once in a while, you can find a trade that does make sense where it's under 20 bucks a share, but usually it's just really, really hard to find a decent trade there because, your commissions can frankly end up taking too big of a chunk out of your premium, because your premium determines your maximum profit. And if you have to pay a high commission on that component, then your maximum profit is smaller. We also want liquidity in the underlying and especially in the options. So we want to look at the bid-ask spread. And it might not hurt to look at volume and open interest too, if you have that data available to you. So here we have, let's see, I always like to train my eyes to the at the money. So 317 bid at 320. So the offer is 3 cents above the bid, which is a little less than 1% of the bid price. Same thing here. 377 bid at 381. That's 4 cents. That's just a little over 1%. 4 cents wide, 5 cents wide, 6 cents wide, 6 cents wide. There's 2 cents, 3 cents, 3 cents, 2 cents. Very, very tight. And to boot, on a lot of these, there's a lot of, this is the bid size. So here somebody's bidding 377 for 54 contracts, and somebody's offering to sell 68 contracts at 381. Like, with a covered call, you're probably not trading 50 of these. So this is perfectly liquid enough. Now, this one is an example of pretty weak liquidity. This is $6.70 offered at 11.20. Oh my gosh, that's $4.50 higher. That's like 65%. The offer is like 65% higher than the bid. Same thing here. Gosh, 275 bid offered at $5. This is terrible liquidity. The sizes aren't awful, but there's a lot of 2 lots and 1 lots showing here. Like, it's really, really hard to trade these. Now, I will tell you, man, I'm just sprinkling in a lot of like good stuff that's not actually even in the presentation, but they're good tips and tricks for you. I will tell you, I will occasionally trade covered calls on illiquid options when I plan to just hold it till expiration and accept assignment if it's in the money, or just let it expire. If you plan on doing rolling, which we'll talk more about, you really need it to be on the left-hand side, good liquidity. Okay. How do we optimize? So like, if you look at an option chain, like this is just one expiration, right? But there's other expirations and there's all these different calls. Like, which specific option should I be trading? Well, let's start with the expiration. The main tenet is less time is better for 2 reasons. One is because you can roll them. Maybe I plan, maybe there's a stock that's really been in a channel for a while, doesn't really move that much. I plan on selling a covered call and keeping a covered call for like a month. Well, I could sell a covered call that expires in a month, say for $4. Or if I sell the 1 month, or excuse me, if I sell the 1 week call, I might collect $1.50. Now, $1.50 is less than $4, but after that week, I can sell another week when that call expires, or really I'd buy it back around a nickel, leaving a nickel on the table, but then taking in, more premium. I would roll it. And if I could collect like $1.50 each time in 4 weeks, I collect $6 instead of $4. So like 1 4-week option, I collect $4. 4 1-week options, I collect a total of $6. It's because I tend to have higher theta if I'm selling close enough to the money. And the really beautiful thing is, if a stock is trading in the channel, I mean, it doesn't just trade flatline, right? It goes up and it goes down. And I like to have enough breathing room or wiggle room to let the stock, have a little bit of room to run up before going through the strike. So, if it ends up being higher, I don't have to sell that same strike. I can sell a higher strike the next time. Or if it goes down, I can sell a lower strike to take in more premium. I get to adjust the strike. I'm doing a lot of these air quotes today. I don't know why. Okay. Now, the thing is with expiration, we need to get enough premium for the trade to make sense. Because sometimes if you sell a really short-term option, you have to sell so close to the money that it's not worth it. And I'm going to go through an example of that in just a second. But next, let's talk about tips and tricks to strike selection. So selecting the right strikes can be different with covered calls compared to other strategies like credit spreads. Because if I'm selling a credit spread, I don't want to get assigned. Like, that's bad if I get assigned. With the covered call, I'd say much more than half the time, I want to get assigned. So the strikes can be set closer with covered calls than I would with credit spreads. And my experience shows that you tend to do better that way. All right. It can feel, if you're a credit spread trader, it can feel a little cavalier to sell closer to the strike, but we have lots of different adjusting techniques and trade management techniques that make that go well. Okay, so the strike and expiration are two parts basically of the same choice. Selecting the best option for this covered call. So we kind of need to balance those two against each other on basically like a sliding scale, right? We want to select a higher strike. Basically we want to select the highest strike where we don't get assigned if we don't want to get assigned, but the lowest strike so we get the most premium. It's this dance, right? So if I want to sell, like, I don't know where this stock was at when, I guess these are all out of the money calls. So the stock was probably at something like 228. Okay. So if the stock's at 228 and I want to sell the 235 calls, that's $7 away from the money. $7 divided by what I say, it's 228. So 7 divided by 228. That's about 3% away from the money. Now, if I sell these calls, I'd be taking in like, if the stock is $228, this is like about 0.1% of the stock price. Sure, I'm definitely, in this example, this is not universally true, but in this example, hypothetical example, I'm saying, yeah, I don't think the stock can move 3% in 7 days. So I'd be happy to sell the 235 calls, but it's just not worth it. I don't get enough. I get 0.1% of the stock price. So I'd have to go out to 14 days. Okay, so now we're doing a little bit better. We're getting basically 0.4% of the stock price, but we got to hold it another 14 days. What if we went out another week, 21 days? Well, okay, so now I'm getting like, I can do pretty good. What is this, like 0.8% or something of that, 0.7, 0.8% of the stock price? But can it move 3% in 21 days? Well, it can move a lot more in 21 days than it can in 7, right? So it's always this balance. If I'm going to go out 21 days, I probably have to go up to the 240 strike. Can't really go up any higher because I'm just not getting nearly enough premium. If I'm selling the 7-day, I probably have to sell a lower strike. 230. Now we're only $2 away from the money. That's like 1%. Those have to be a very low volatility stock for that to make sense. 232.5 might be the happy medium. Okay. So estimating probability of assignment at expiration. So like, look, here's a handy little tool, but it's not really mathematically accurate. So I don't want you to rely heavily on it. But if you have access to the individual options delta, that's a loose rule of thumb for the likelihood of success of that option expiring in the money. Now, if the option expires in the money, if the call expires in the money, you're going to get assigned. So again, that's not really mathematically accurate. So don't get super hung up on it. But, there's one thing to realize. You make money with covered calls mainly as time passes. Sure, the call component does have a negative delta. So if the stock goes down, and therefore losing money on the stock, therefore losing money on the covered call trade, you can buy the covered call back sooner if it goes down. But generally, you need time to pass. You make money on theta, time passing. So we're typically going to hold these pretty close until expiration, or maybe even actually until expiration. So the delta is, I'm saying, excellent tool for estimating assignment. Okay, it's an excellent tool for estimating assignment. So I'm okay with you using it, but just don't get hung up on it. So early assignment is only done if it makes sense by somebody who's long that call. You're selling your right. You don't have a right. You can't choose to be assigned. You get assigned if it makes sense for the person on the other side of the trade. And that's a simple decision for that person. First of all, that call has to be in the money, and there has to be very little or no extrinsic value or time value left. Because whenever someone exercises an option, you lose the time value, you lose the extrinsic value. So there has to be little or no extrinsic value. Now with calls, market makers are always short stock against their long calls. And they earn, when market makers are short stock, they actually earn what's called a short stock rebate. They get interest on the money they take in on that short stock. Nice to be a market maker, right? The other time so market makers tend to not like to exercise their long calls because they like to keep collecting the interest. The time they will exercise their long calls is if the ex-dividend date is coming up, specifically if it's tomorrow, for whatever day you're looking at it, and it's in the money and there's not a lot of time value, then they will exercise that long call so that they get the stock, so that they get the dividend. Make sense? Okay. Are you at risk of assignment? More often than not, assignment is part of the plan, as I've mentioned a couple times already. However, there are some risks. If there's a big, huge gap higher, which would result in a covered call assignment, you could end up leaving a fair amount of money on the table. So you then end up having a dilemma. What do you do if the stock gaps up higher and for whatever reason you get assigned? Again, you're probably only getting assigned if the ex-dividend date is tomorrow. There are a couple other reasons too. If the stock is hard to borrow because a lot of people are shorting it, what can happen with hard to borrow stock is, the clearing firm can just call up the trader and say, hey, you know how you were short stock this morning? Well, you're not anymore. The person who had the stock wanted it back. And then you have to scramble to hedge your deltas if you're a market maker. So you can get assigned early. And if you do, well, what do you do? Well, there's a couple of things. When you get assigned, you basically have two choices. You can A, immediately sell cash secured puts. And at this point, you will have the cash in your account, remember, because you got assigned on the stock you own. So you sold the stock and got the cash. So you could sell a cash secured put, which is not really the topic of today's class. Or you could wait for a pullback to sell the puts. Now, there's some potential problems and some potential benefits to each of these. Now, and by the way, when you get assigned on a covered call and then you sell puts, that becomes a broader strategy, which is called the wheel trade. So if I just say, oh, I got assigned, I'm going to sell puts. Well, okay, now you have downside risk. But if you had the covered call, you own the stock, you already had that anyway. So now you still have the same risk, but you get another premium. If you wait for a pullback, you could miss an opportunity. I advise you to seldom wait for a pullback because you cannot predict the future. Okay, so general lessons learned. If you get assigned and you wait for a pullback and the pullback never comes, it's like that Charlie Brown Halloween special, like I got a rock, like you're just out of luck, buddy. Stock went up and you missed it. Because you got to be in it to win it. Fear of being wrong is what keeps traders out. I was just having a big, long, basically discussion today with somebody about the importance of psychology when it comes to covered calls. We actually have like the whole blown out covered call class, and a lot of it is on the psychology of it. You want to be good at covered calls, you got to really understand the psychology. Now, the big secret here with covered calls is you're always going to be wrong, which kind of sounds weird, right? Like either the stock's going to go up through your strike and you're going to wish you didn't sell the call, or it's going to go down more than the premium you collected on the call and you're going to wish you just sold the stock. And every now and then it's going to be in the middle too. More often than not, it should be in the middle. But like, you're kind of conceptually always wrong and having a hot potato and having to manage it. But in the long run, the premiums you collect over and over and over again outweigh the temporary directional losses. Okay, when to roll and when to time the market. So studies show consistent rolling outperforms in the long run. What I mean by rolling is, okay, I own the stock at 70. I'm sure at the 75 call. We're getting, now it's expiration day. The stock's at 72 now. Okay, my call's about to expire. I'm going to buy this call back at a nickel and sell the call that expires the next week at $1 or $1.50. Or maybe I'll sell the higher strike, instead of the 75 call, maybe I'll sell the 76 or 77 call. I can roll out in time or up to a higher strike or down to a lower strike. So studies show consistent rolling outperforms in the long run, but what if the volatility is underpriced? Now, I haven't talked much about that. If you have access to some volatility analysis software, like a volatility chart, we always prefer to sell covered calls when volatility is overpriced, meaning the option is overly expensive. We have some techniques. One is volatility analysis for telling that, and it's not really an absolute. For me, if I'm just initiating a covered call, I will first look to see, I look to see if I'm getting a big enough premium just subjectively. But then I'll be more objective and look at the volatility. And if it's overpriced and it makes sense, I'll trade it. But then when I roll, I don't care about the volatility quite as much. Just the price needs to make sense. What about unique situations, such as looking for a correction or a breakout? Well, this is one with the coronavirus, 2020. I happened to get assigned on some covered calls, I don't know, a month or something before then. And if you remember before then, the market just kept going up and up and up. And I was like, oh, crap. I got assigned and I was waiting for a pullback and I'm missing out. And then, I'm not going to lie, I got pretty lucky because of the coronavirus, because the stock went, the whole market went down, 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 down. And that's when I chose to start selling puts that were very expensive because volatility is very overpriced then. Sometimes you'd rather be lucky than smart. I think that maybe I had a little bit of both there, but I'm definitely not discounting the luck portion. So if there is a unique situation like you're really looking for a correction or a breakout, not just like, oh, wow, that happened. Great. It could be okay to time the market, but generally you don't want to. Selling underpriced options is theoretically unfavorable. However, in the long run, volatility is usually overpriced across the board. Thus, on average, you can sell overpriced volatility. However, if overwriting, which basically is selling a covered call, individual equities like Apple stock, Amazon stock, it might make sense to select a different equity that does have overpriced volatility and get out of selling underpriced options. If I'm looking for a correction or a breakout, well, that should be treated as a very special case. It can be very, very tricky to correctly call a market correction. Very few analysts in history successfully called market corrections. Who's the female broker in 1987? Oh, Elaine Garzarelli. A lot of people still remember her name because she called the crash of 1987. If I'm still remembering that in 2024, that's a pretty unique, special, thing she did there. Most people can't do that. So we still probably don't want to do a lot of market timing. Staying out of spiders from 2024 would have led to greatly reduced profits. However, we do sometimes have what we call capitulation trades that can lead to oversized profits. That's an opportunity that comes around maybe once every 10 years. Coronavirus is a perfect example. When all that started to happen, the whole market panicked. And some of that was for good reason, right? With people staying home, not being in their jobs, there was an economic downturn. And with the supply lines issues that we had, that led to a temporary downturn. So there was concern, but as always, people overcompensate. And at some point, you got to say, geez, Louise, like, isn't this sell-off over? Like, it just seems so overdone. And that's when people capitulate. They say, oh my God, I got to sell my stock, even though the market's down 20% or whatever. I'm just so panicked. I'm like puking every day. I give up. I capitulate. I'm going to sell the stock. And that's when you get that last push down before it goes back up. When you can identify those, which is very hard, and they come along very infrequently, that's an excellent time to sell puts. Upside breakouts tend to lead to lower volatility, making planned covered calls less desirable. So covered calls on losing investment holdings. What if I own a stock and it goes down a little bit, and I think to myself, you know what? I don't want the stock anymore. Okay, it happens sometimes. Usually if it's planned to be a long-term investment, I just wait. But every once in a while, you'll get into this situation. Hey, I bought this for the buy and hold strategy. It's down now. Maybe some new novel news came out that you didn't expect. And you think differently about it. Hey, I want to get out of this, but if I sell it here, I'm going to lose money. Well, what can I do? I can sell an in-the-money call. So this was a long-term investment predicated on momentum building from earnings, say. It's a hypothetical example. I don't even know if earnings was this day, but let's just say. We bought here. And hey, we were doing good for a couple of weeks. And then whoopsie whoops. We decide we're going to hold on to it for a while. And we're just like, you know what? This is just not working. I wish I didn't make this investment. I want to get out of it. So if we assume that we originally bought these shares at $63.95, now the stock is at $62.50. So we're down $1.45 on this. and my thesis is no longer valid, which is a simple way for saying I changed my mind. I want out of the investment. What I could do is this, with the stock at 62. Hold on a second. Got a typo here. Hold on a second. Right? Is that what I meant to do? Yeah. So with the stock at 62.50, the 62 calls, which are 50 cents in the money, are trading at $2.15. They're in the money by 50 cents, which means there's $1.65 of time value, right? Because in the money value plus time value needs to equal the total premium. 50 plus 165 is 215. So if I sell these calls at 215, I would sell the stock $1.65 over the current value. So how do I come up with that? Well, if the stock is at 62.50, but I'm selling somebody the right to buy it from me at 62, I'm going to sell it 50 cents worse, but there's 50 cents of in the money value that I'm getting. So the benefit is just the time value, right? So I'm down $1.55, but I'm getting $1.65 in time value. So I'm basically making back everything I lost. This only works, by the way, when there's a very small move lower. If it's a big move lower, I think we already covered the stock repair strategy, right? Yeah, we covered that on September 3rd. So go through the archives and watch that if you're looking for a way to deal with bigger losses. So think about the in-the-money repair call. Think about it as a cash secured put, right? If we stay above the strike, we get the premium and we're out of the stock. Only if it goes below the strike is it a problem. We assume assignment, but it won't always happen. If the stock goes down, we're not going to get assigned. So in that regard, it is kind of like cash secured put. Okay, Catherine had a couple of questions. I'm going to answer a couple of questions. In the meantime, if you aren't following us on social media yet, now is the time. Get out your phone, go to the camera app and hover it over one of those crazy looking QR codes and a little yellow bubble pop up under it. And you touch that and hit follow. It's very important that you follow. Like if you go to YouTube, it's very important that you hit follow. Okay, so earlier, Catherine asked, 2 of my wheel strategies covered calls backfired when the companies run quickly through my strike. Uber from 26 and STNG from 20. I keep rolling my calls up and out for 2 years, still far from the current price. Comments? Well, yeah. Trying to think what STNG stock is. Oh gosh, it's not hitting me right now. But you want to avoid stocks that really whip around or that are on like, Tanker Scorpio. Oh yeah. I know that stock. Right. They're like tankers for rent, I think, if I'm not mistaken, right? And don't they do a lot of business with Russia or something? Yeah. Okay, well, anyway, yeah, they have a huge fleet, yeah. You want to avoid the ones that are, likely to zip higher. Like, you can't read the future. You don't know if a stock's going to go higher. But if there's a ton of volatility, there would have to be very high implied volatility, thus very expensive options, and you would have to sell a pretty high strike to leave enough room to run with those. Those are really tricky. For me, The stocks that I like to do covered calls on are like spiders, Amazon and Apple. And don't get me wrong, both of those can have some pretty good runs to the upside, but usually not. Think of stocks that, they're log normally distributed. Every once in a while, tails, you get a big move up or down, but most of the time it's kind of back and forth. So, I mean, I would say the first thing to do is screen your candidates so that you reduce your chances of ending up in a scenario like that. So you kind of have two choices. One is just give up, or two is just keep rolling. I can't tell you what to do. So another comment, I bought 100 RIG. You're welcome. Bought 100 RIG at $8.27, sold a covered call. Stock fell quickly. It's $4.29 now. Calls are too cheap to sell. Right. I'm bullish long term, but still, but sit on blocked capital. Best course of action. Well, yeah. That's another one where even at 827, you're just not getting much for covered calls. And whatever you are getting, commissions may or may not eat too much into how much you're getting. And at 429, you're never finding a call that makes sense. So you have a decision to make. One, well, I mean, there's infinite choices, but the two that come to mind are sit on it and wait, or sell it and employ that capital somewhere better. Now, one thing that I will point out is there's something called the sunk cost fallacy. Ever hear the sunk cost fallacy? That means, well, in trading, I mean, it has applications other than trading. Well, here, let's say you buy tickets for a concert or a sporting event, right? And on that, and it's for the Tampa Bay Buccaneers, right? And the hurricane's supposed to hit that day. You can't get a refund on the tickets. If you don't go, that money's gone. But there's a hurricane coming. What are you going to do? You're not going to go to the game. I'm sure they're going to cancel the game if the hurricane's coming. So when money is lost, money is lost. And as traders, we make our decisions to make the best trade possible with the capital we have. However much you lost on that trade, that money's gone. But you've got money in that trade that you can keep in that trade if you think that that is the best opportunity for that cash, or put in another trade if you think there's a better opportunity than that. When you lose money, you want to get your money back, but you don't have to get it back on the same stock. So that's all I can really say about that. I know. Emotions. The bane of traders. All right, folks. Hope you got something great out of this class. I look forward to seeing you next time. And over and out. Have a great rest of your day. Bye.